In today's market, it's so easy to get swept up in the chaos, right? All the hype, all the fear, it's a lot. But what if there was a way to tune out all that noise? A solid, rational philosophy for investing. Well, today we are diving into the timeless wisdom of the man himself, Benjamin Graham, the father of value investing, and his absolute masterpiece, The Intelligent Investor. So, where does Graham even start? He points out the single biggest trap on Wall Street. This quote just says it all. It's that herd mentality, chasing what's hot, buying high because of FOMO, and then panic selling when things dip. He argues this is the exact opposite of what actually works. It's basically a guaranteed recipe for failure. And this just lays it out so clearly. On the left, that's Wall Street's way. It's all emotion, it's all reaction. And on the right, that's Graham's way. It's simple, it's logical, it's almost boring, but wow, is it effective. He taught that you should treat stocks like you're buying a piece of a real business, not just some ticker symbol flashing on a screen. Just follow one simple rule. Buy cheap, sell dear. Okay, so how do we actually do this? Graham gives us three core principles, and the very first one has absolutely nothing to do with stocks or the economy. Nope, it's all about you. Before you can even think about being an intelligent investor, you have to know who you are in this game. What's so fascinating is how incredibly strict Graham's definition of an investment is. Look at those words: thorough analysis, safety of principle, and an adequate return. If what you're doing doesn't check all three of those boxes, you're not investing, you're speculating. And listen, there's nothing wrong with speculating, as long as you know that's what you're doing and you're not betting the farm on it. So that's the big question you have to ask yourself. And you have to be honest. Are you doing the deep homework and putting safety first? Or are you just making a bet that the price will go up? Your answer to this changes everything. Getting real with yourself right here is the very first step. All right, so once you've decided, okay, I'm an investor, Graham says you immediately come to a fork in the road. And this brings us right to his second principle. You've got to choose a path that actually fits the amount of time and effort you're willing to put in. Graham basically says there are two types of investors. The defensive investor just wants a simple set-it-and-forget-it kind of strategy that gives good, solid results. Then you've got the enterprising investor. This is the person who's willing to roll up their sleeves and do the hard work to find those hidden gems and try to beat the market. Graham is super clear about this. For almost everyone, the defensive path is the right one. So let's stick with that defensive path for a minute, because its real power is just how simple it is. The whole strategy is designed to protect you from making huge mistakes, and it really doesn't take much work to maintain, which, let's be honest, is perfect for most of us. And here's the heart of it, a simple 50-50 split between stocks and bonds. This isn't just about not putting all your eggs in one basket, it's a kind of automatic genius move. When stocks shoot up and your portfolio gets top-heavy with them, you sell some to get back to 50-50. You're automatically selling high. And when stocks crash, you sell bonds to buy more stocks, automatically buying low. Brilliant, right? And for the stock half of your portfolio, the rules are just as simple. Buy a bunch of different, big, well-known companies. But it's that second rule, do not overpay, that is the absolute key. In fact, it's the perfect setup for Graham's final and most powerful idea of all. And that brings us to principle number 3. This is the big one, the concept that Graham saw as the secret to all sound investing. He literally called it the investor's ultimate weapon for protecting yourself and locking in profits. The margin of safety. It's such a simple idea, but it's pure genius. It just means buying something for way less than what your careful research tells you it's actually worth. So if you figure out a business is worth $1 a share, you don't pay 98 cents. You wait. You wait until you can buy it for, say, 60 cents. That 40-cent gap, that's your margin of safety. It's your cushion against bad luck, mistakes, and just the general craziness of the market. Graham used this principle to hunt for what he called bargain issues. These are just companies where the stock price has totally disconnected from the reality of the business itself. And when that happens, it creates a massive margin of safety for anyone who's paying attention. Okay, but what does one of these bargains actually look like? I mean, how can a company really be worth so much more than its stock price? Let's walk through a classic Graham-style example to make this super clear. So first, you do your homework. You find a company whose net working capital is $30 per share. Now, think of this as the company's fire sale value. It's the cash they could get pretty much overnight if they sold all their easily sellable stuff and paid off every single debt they have. Then you look at the stock market, and this is where it gets wild. For whatever reason, maybe there's a panic or some bad news, the stock is trading for just $20 a share. The market is valuing this entire company at a price that's a full 1/3 less than its immediate cash value. And here it is, the aha moment. At that $20 price, you're not just getting all the company's long-term assets, the factories, the patents, the brand name for absolutely free. You are actually getting paid a $10 per share premium just to take it off the market's hands. That right there is the ultimate margin of safety. So when you boil it all down, after all this analysis of markets and companies, what's the most important takeaway from Graham's philosophy? Well, it turns out the real danger isn't where most people think it is. It's a lot closer to home. This really is Graham's deepest insight. The greatest risk to your money isn't the stock market. It's you. It's your emotions, your impatience, your lack of discipline. A market crash is temporary, but a loss that comes from your own bad decisions, that can be permanent. But Graham's wisdom gives us a simple 3-step defense. First, know your role. Be an investor, not a gambler. Second, choose your path. Build a simple portfolio that actually works for your life. And third, the foundation of everything. Never, ever pay full price. Always, always demand a margin of safety. Ultimately, everything Graham taught boils down to this one powerful question. He pictured the market as your business partner, Mr. Market, who's, well, a manic depressive. Every day he shows up and offers to either buy your shares or sell you his at some wild price. So the question is, do you let his crazy mood swings control you, making him your master? Or do you ignore his nonsense on most days and take advantage of his fear on his worst days, making him your servant? That choice, right there, is what separates an intelligent investor from everybody else.